Hello friends, welcome to PrepMate classes. In this lecture, we will learn about monetary policy. Suppose you get rupees 10,000 more per month. Will you be rich or poor? Of course rich. Then why doesn't RBI print more currency to make all of us richer? Let us understand monetary policy to answer this question. Monetary policy is the policy related to money supply in the economy. In India, Reserve Bank of India manages money supply. While managing money supply, RBI keeps primarily two factors in mind: inflation and economic growth. Inflation is undesirable while economic growth is desirable. How money supply affects inflation and economic growth? At times of increase in money supply, people consume more products and invest more money, leading to higher economic growth. Greater demand for the products on account of higher consumption and investment leads to inflation. To conclude, in times of increase in money supply, inflation rate as well as economic growth increases. On the contrary, if there is decrease in money supply, there is lower demand for products and reduction in investment. Consequently, the rate of inflation as well as the economic growth reduces. Working of the monetary policy. When inflation is high in the economy, then the main focus of RBI is to target inflation, and thus the growth objective is sidelined. Inflation targeting is given priority over economic growth because inflation affects both rich as well as poor, whereas economic growth mainly benefits the rich. To counter inflation, RBI reduces the money supply in the economy. RBI does this by making credit dearer or loans costlier. Thus, in times of high inflation, RBI adopts dear money policy. On the contrary, when inflation rate is low or moderate, then the main focus of RBI is on increasing growth in the economy. Therefore, RBI increases money supply by making credit cheaper. Thus, in times of low inflation, RBI adopts cheap money policy. Let us now evaluate on what we have learned on monetary policy. Question number 1. In times of inflation, RBI adopts which of the following steps? Increase in money supply, adoption of cheap money policy, reduction in interest rates, adoption of dear money policy. Option A is incorrect. In times of inflation, RBI reduces the money supply. Option B is incorrect. In times of inflation, RBI attempts to increase interest rate. Option C is also incorrect. Option D is the correct answer. Question number 2. Which of the consequences can take place with the increase in money supply? Increase in inflation, increase in economic growth, reduction in public savings, increase in public expenditure. Statement 1 is correct. Increase in money supply increases demands for goods and thus causes inflation. Statement 2 is also correct. Increase in money supply increases investment and thus causes economic growth. Statement 3 is incorrect. Increase in money supply increases public savings. The statement 4 is correct. Increase in money supply leads to increase in expenditure. Thus, option B is the correct answer. For best learning, you can watch this video along with PrepMate's Engage UPSC series, which is available online as well as offline. Book features: complete subject in a single book with practice and past year questions at the end of the chapters. Model answers for UPSC mains from authors. Using the application PrepMate and web portal prepmate.in, you can access comprehensive digital support in form of videos, mock prelims, answer writing practice, and regular updates.